Welcome to Course 2, Unit 5, Lesson 1, Income Investing. In this lesson, we're going to learn about what income investing is, and we're also going to learn techniques for picking stocks that are income investing stocks. So let's get started. If you're like a lot of people, you're probably wondering how you might pay for your retirement someday. So income investing is going to be something that can really help you out as you plan for that. So how do you plan on paying for your retirement? Let's imagine that you're 65 years old and you're looking to retire, and that you have $500,000 in savings right now at the age of 65. If you spent $50,000 a year of that savings, and you also invested that $500,000 at 7% a year, you'd be broke by the age of 80. And this is something that I don't think a lot of people really consider and think about. Now, this would be obviously assuming that this person wouldn't have any type of retirement benefits or anything like that. But I throw that figure out there to kind of give you an idea of how much money it really takes in order to retire. And this would also be assuming that this person would own a house, it'd be completely paid for, and they'd have no debt. If you throw those variables in, that would be even depleted faster than just 15 years. So this is something that you have to plan for. This is something that you have to think about, because if you don't do it properly, you're going to be in a situation that when you're older, you're not going to have the funds and the resources to continue living the lifestyle that you want to live. So that's why I'm introducing income investing. So what is it? Okay, income investing is purchasing stable stocks and bonds that pay dividends and coupons. If you own enough of these stocks and bonds and you acquired them through the years, the dividends and coupons will then provide the income for you into your retirement. And if that income is enough to meet your spending requirements, then the equity and par value of those investments will remain or even grow as time marches on. So to give an example of that, let's say we got Jack here, and let's say that Jack maxed out his IRA from the time he was 22 years old until the time he was 65. And if he was making that $5,000 contribution each year from that time duration that I just mentioned, if his money grew at 7%, he'd have almost about $1 million. So if that's the situation, and let's assume that Jack was buying companies that were paying dividends, paying those 3% dividends, and purchasing bonds that were paying decent returns like 5 or 6%. If he had been buying these throughout the duration of his life up till the age of 65, those dividend payments wouldn't be 3%, they would continue to grow with the company, and they might turn into 5% or 6% based off of that initial price that he purchased the stock for. So let's assume that his average over that duration is 5%. So if Jack has $1 million saved when he's 65 and he retires, those stocks and bonds that he would have been purchasing throughout that duration will be paying him $50,000 a year just in income alone, based off of the dividends and coupons that he'd receive off of that $1 million. So that's what a 5% return on dividends and coupons will bring you with $1 million. So let's assume that if Jack adheres to the rule where a lot of people recommend that if you're 30 years old on your birth certificate, that you should have 30% invested in bonds and 70% in stocks. I'm not going to go as far as to say that, but we're just going to use this as an example and say that Jack adheres to that advice. And since he's 65 years old, let's just say that he has about 60% of his money in bonds and 40% in stocks. So that 40% equates to $400,000 for his stocks. And if that's the case, those stocks are going to continue to grow just as long as he picked good, stable companies that are growing their equity and also growing their earnings. That $400,000 is going to continue to grow as it continues to pay him the dividend payments as well. So his $50,000 a year that he's receiving in totality for all of his investments might turn into $55K, it might turn into $60K as those dividend payments continue to increase on that $400,000 of stocks and equities. So how can you invest in a company that provides those benefits now and into your retirement? And the answer is that you have to really adhere to all the advice that I mentioned in the Course 2, Unit 3 lessons, where you have to invest in a stable company and you have to also invest in a company that pays dividends. Now, I didn't really describe why you want to pick something that pays dividends back then, but this is the reason why, is because you're income investing. So let me give an example of companies that are paying decent dividends but had a lot of debt and how those dividends weren't received. The thing that you got to think about is you got to think about as if you're the owner of this at age 65. So the last thing you want to do is to own a company that has a dividend and it might be paying a 30-cent dividend, but then it goes into a recession and the company drops that dividend down to, let's say, 10 cents. So if you had $1 million and you're receiving that 30-cent dividend, that might equate to, let's just say, $30,000 whenever you add up all the shares. And if that company would then drop its dividend, you might only receive $10,000, which would be a $20,000 cut because of the market conditions. That's something that you want to avoid whenever you're old and you're retired. You don't want to be dealing with something like that. You want to be continuing to receive those dividend payments. So I'm going to show you companies that dropped their dividend payments during the 2008 recession, and then I'm going to show you companies that just sustained their dividend payments during the 2008 recession. And what I'm going to show you is that the companies that dropped their dividends were the companies that had a lot of debt. The companies that sustained their dividend payments were the same companies that did not carry a lot of debt. So right here I have General Electric listed on the top and JP Morgan listed on the bottom. And the graph that you see is just the Dow Jones Industrial Average, just to kind of show you how the market dropped significantly there in 2008 and into 2009. So during that time, if you see that red line, that is right where GE and JP Morgan, which is the two companies here, General Electric and JP Morgan, dropped their dividend payments right there in about the middle of 2009. And they went from paying GE went from paying a 31-cent dividend down to a 10-cent dividend around that time. Now, if you look over to the right of GE, you can see that I have the debt to equity listed on that as a 5.0, and that is extremely high. If you remember back to the lessons in Unit 3, I had mentioned that you're wanting to find companies with a debt to equity below 0.5. So for a company to be listed at a 5.0, that's extremely high. That means that they have $5 of debt for every $1 of equity in the business, and that's a lot of debt. So what GE had to do during those troubling times is they had to cut that dividend, which was a wise decision for the company. They shouldn't be putting more money in their owners' pockets whenever they're going through difficult times and have a lot of debt. So they made the right decision, but at the same time, you don't want to be the owner of something like that at age 65 when you're relying on that money as income. So that's why I highlight this, and if you look at JP Morgan, they actually even took a steeper cut. They went from 38 cents down to 5 cents, and they had actually a lower debt-to-equity ratio than GE, but it was a financial company, and that was the result of the financial crisis. So something to look at. Look at that comparison and how the debt to equity is showing you how, hey, there's a company that's probably going to be cutting its dividend real fast if they're carrying a lot of debt. So let's go ahead and look at two companies that didn't drop their dividend payment during the 2008 recession. I left the red line up there just to show you where the two previous companies were at, but those don't have anything to do with these companies. So Johnson & Johnson during the 2008-2009 crash, they actually increased their dividend payment. They went from paying a 46-cent dividend up to a 49-cent dividend during that time period. Now, if you look at their debt to equity, it was a 0.28, which is below the 0.5 that we're looking for on investments. So there's an example of a company that held their dividend, and if you were 65 years old and you were relying on that income to pay the bills and to live your lifestyle, there's a company that would have continued to pay you your money. And that was all a result of the fact that they didn't have a lot of debt. And when we look at the company below, that's Intel. That's the ticker for Intel. And you can see that Intel's dividend actually remained exactly the same at 14 cents as what they were paying before the recession, and after the recession they continued to pay the same thing. And if you look at their debt to equity was a 0.03, which is pretty much non-existent. That company pretty much had no debt at all. So there's an example of two companies that did not drop their dividend payment during a really bad recession, and it was all a result of the fact that they were in a very good conservative situation where they didn't have a lot of debt and they were growing their equity consistently. So those are the companies you're looking for, and those are the companies you want to buy, which we already learned back in Unit 3 from this course. But there's another example of why you want to do that, is because if you're income investing and you're going to be relying on that income into your retirement, you can rest assured that you have a much better chance of collecting those dividend payments and the company not dropping them. Okay, so write this down. Always, always, always purchase assets that will increase your cash flow next month. Okay, if you stick to that rule, you're going to see a compounding effect that you're not going to find anywhere else. Okay, so let me give you two examples. Let's say I went out and I purchased 100 shares of the Shell Oil Company. Okay, you know what the result of that action would be? The result would be that I would have $28.66 more next month than I have this month. And that's a result of those dividend payments that I would be receiving from the Shell Oil Company. So now here's another example. Let's say I went out and bought a $1,000 par bond at a 5% coupon. The result of that decision means I'm going to have another $4.16 next month in order to invest. So whenever I'm investing in these companies that are increasing my cash flow, it has a compounding effect. So let's assume I typically have $1,000 to invest each month. Every single month I'm investing $1,000. If I would have chose that first course of action, that means next month I'm going to have $1,028.66 to invest. And then the following month after that, I'm going to have even more because I keep following that rule where I'm investing in companies that are going to continue to increase my cash flow each month. And that's really the essence of income investing. Using this approach will provide increasing liquidity every month so you can invest in the most undervalued security. So let's say you were purchasing stocks that weren't paying a dividend. You were just buying companies that you were counting on the market price to increase. Okay? Let's say the market then goes through a recession and you're still holding that company. That company is not providing any type of cash or any type of liquidity for you to invest in that opportunity because the market's low. Now, if you're consistently buying companies that pay dividends, you're receiving those dividend payments, so then you can now take that money, take that cash, and plug it into the now whatever undervalued asset is out there, whether it's stocks, bonds, preferred shares, or whatever. So income investing provides you liquidity to constantly be plugging that cash into the most undervalued asset. So here's our conclusion on income investing. Income investing is going to provide you quarterly payments or semi-annual payments if you're doing bonds that are going to give you a cash flow and a source of income whenever you go into retirement. So if you start buying them now, those dividend payments are going to do nothing but increase if you're buying decent companies, and you're going to have even a higher yield on your money whenever you go to retire. And here's a rule of thumb that I like to use. I like to find companies that pay about 1/3 of their earnings through dividends, and the other 2/3 go back into the book value of the business. That 2/3 going back into the business, into the book value, I don't have to pay taxes on that, so that's why I prefer kind of this ratio. But that 1/3 then affords me that opportunity to continue to invest that cash flow into undervalued assets. So that's the ratio I personally use, and that's what I'm kind of looking for. Now, I'm not going to discount a company that might have a little bit less or a little bit more if all the numbers look really well, but that's just kind of a little bit of a rule of thumb that I use, and that you can adopt that as well if you like it. So that concludes Course 2, Unit 5, Lesson 1 on income investing. Hopefully you've learned what income investing is, and you've learned a couple ways that you can employ the technique. And I'll see you guys in the next lesson.